Now let's talk about Section 1250 recapture rate is a maximum of 25%. What does this mean? With home office, it's considered a Section 1250 item, meaning that any time that you have to recapture and pay taxes on it, the maximum rate you're going to pay taxes on is 25%. So it's not the ordinary income rate. And if you think about it, if the client is at a higher bracket, like maybe the 32 to 35, 37% bracket, being taxed at 25% maximum for recapture is actually the perfect way to pay lower taxes when a client is in a higher bracket because they're only paying at a max of 25%. So remember, Section 1250 allows the recapture rate to be 25%. However, for Section 1245, which are normally like tangible business items like a car or computer equipment or some kind of equipment, that's under Section 1245, and that's actually taxed at ordinary income rate. They don't have the special privilege of 25%. So when it comes to Section 1245 items like equipment, and the business actually sells that equipment and makes a profit after taking all the adjustment gain, that profit is taxed at the ordinary income tax rate, not at this 25% rate. So that's why having a home office, taking advantage of 1250 is actually really important that we do for the client and making sure that we apply this 1250 rule in the tax program. Now, let's go over a quick example of how this works. Let's say this is the client right here. She's a business owner with a home office. She's consistently in the 32% bracket every single year, and she's been taking home office depreciation for $2,000 a year for the past 5 years. So now, how does this look? Let's add it all up, depreciation taken. So remember, it's $2,000 for the past 5 years. So that's $10,000 total depreciation that she took on a home office. And because she's in the 32% tax bracket, if you take the 10,000 times 32%, that means total, she saved $3,200 in total tax savings just by having a home office. So we know how much she saved in taxes every single year just by having a home office, a total of $3,200. Now, let's kind of go back in time in history right now. She bought the house for $400,000, and let's just say now she's ready to sell it, say 5 years later, for $450,000. Remember, when we recapture depreciation, we have to make the adjusted basis. So we know she bought the house for $400,000, but she's depreciated $10,000 worth over the past 5 years. So that means we have to reduce this by the $10,000. So that means that her adjusted basis is actually $390,000. And remember, we take the original purchase price minus the amount of depreciation taken over the years. That equals the new adjusted basis. Now that we know the adjusted basis and we know the sale price, there are 3 questions that we have to ask ourselves when it comes to running this calculation. The first question is, what is the total gain? The second question is, what portion is gain from the depreciation that we have to recapture? And what portion is gain allocated to personal? Meaning that there's going to be 2 different math calculations we do here. The first one is the recapture calculation, and the second one is the capital gains calculation that also will be the home exclusion calculation for this client right here. So let's go through the first one. What is the total gain? We know the basis is $390, sale price is $450. So that means the difference here is going to be $60,000, and that is the total gain, $60,000. Now, what portion of that gain is coming from depreciation? Remember that we bought it for $400,000, and then because we lowered the basis with the depreciation of $10,000, that made the adjusted basis at $390,000. So that means the gain from the depreciation and the amount that we have to recapture is going to be $10,000. And the third question is, what portion is gain allocated to personal? Now, we know out of the $60,000, $10,000 is coming from the recapture of depreciation, meaning that the remaining balance or the remaining gain that we haven't accounted for yet is for the personal side. So that would be the $50,000. An easy way for this to make sense with what portion is allocated personal, let's just say there was no home office deduction and we never took depreciation. That means that their purchase price, their basis is $400,000 and they sold it for $50,000. So that means that their gain is $50,000, right? So that's how you calculate the personal side. And we only do the recapture because of the depreciation that we took of $10,000. Now let's get visual on this one. So we have a graph right here. This part right here, the light blue, is going to be a section 2. Hopefully you can see it in the camera. So this whole bar graph from here to here, that's going to be $60,000 of the total gain. Of that, 10,000 here is going to be for depreciation, and 50,000 here is going to be for the regular personal capital gains or home exclusion, right? So depreciation, personal, total gain from top to bottom. So this is an easy way to see out of the $60,000 gain, what's allocated to depreciation, what's allocated to personal. So we're going back to this. We know that we took depreciation of $10,000. There was a tax saving of $3,200 during those 5 years that she depreciated the home office. Now let's calculate how much tax that she's gonna have to pay for this recapture of depreciation. So we're gonna have to calculate 25% of the $10,000 depreciation because that's the max. So that means that 10,000 times 25% equals $2,500 that she's gonna have to pay in taxes. So she's reporting this $10,000 as income on the tax return in the year of the sale of the house, and that's gonna be taxed at 25%. So that means that the tax is only going to be $2,500. So now that you have two numbers, you have the amount that she saved while she depreciated the property, which was $3,200, and then the amount she's gonna pay back in taxes is $2,500. So as you can see that she saved more and paid less in taxes. So we still came out ahead $700 by doing it this way because she got a deduction where she saved $3,200 throughout the years, and then now she's just paying back the taxes of $2,500. So $700 of extra tax savings just by taking this home office.